Hello, and if you're new to the world of corporate bonds, welcome. Corporate bonds are an investment and they're also a way to save your money. Today, we'll share how simple they are and some tips on how you can get started saving your money. What is yield and why does it matter? What are the most important criteria for any corporate bond? What are the key financial metrics? And what should you absolutely avoid? To get started, let's suppose you had $100 in a bank CD that just matured and you're looking for a way to earn a little more on that money. A friend of yours happens to mention she's looking to borrow $100 and can pay $5 in 6 months. We'll call that a coupon, and another $5 along with $100 in a year. You earn $10 on the 100. That's a 10% yield, which sounds pretty good. So you go ahead and lend her the money. Now, suppose on the day you make that loan, you mention it to a neighbor who says, "That sounds like a great return. In fact, he'll pay you $101 right now to step in as the lender to your friend." That's a full percent you make on your money before the day's even over, and now you have $101 to go make another loan. Your neighbor collects the $5 coupons and $100 principal on schedule, but he paid $101 for those, so his yield is only 8.93%. Don't worry about the math. Nobody except the Rain Man can do it in their head. What's important is that the yield is the annualized return to you from the fixed coupon and principal payments relative to the amount you invested. To add one wrinkle, let's say that before your friend borrows the 100, she asks if she can pay the whole amount back after 6 months with just the first $5 coupon and the full principal. You check your calculator and realize that's still a 10% yield on an annualized basis, which is a lot more than your bank CD was paying, so you're good with that. You go ahead and hand over the $100, have the same conversation, including the prepayment option, with your neighbor who says the same thing. $101 in your pocket right now. I'll be the lender, and that's done. 6 months later, your friend has come into some additional cash herself, wants to pay back all her debts, and exercises her prepayment option, paying the $5 coupon and $100 principal back to your neighbor. Because your neighbor paid you $101 and got a total of $105 after 6 months, his annualized yield is down to 7.92%. Still a whole lot more than a bank CD, but less than if he had gotten the additional $5 with the 100 after a year. Your neighbor is completely fine with this because you explained the prepayment option up front, and he knew the worst possible yield he could earn was 7.92% for 6 months. Corporate bonds are exactly the same. You are the lender to a company. They pay a fixed dollar amount for every $1,000 they borrow, and in most cases, they can pay the money back before the last possible date. What's important is that you always think of your return, your yield, as the worst level it could be, and know the date you would get your money back in that situation. That yield is called the yield to worst, and the date is the workout date. You may get your money as late as the final maturity and earn a higher yield, but it's the borrower's choice. By lending to your friend or to a company in the form of a bond, you're saving your money for one very important reason, which is the fixed date by which the borrower is absolutely contractually obligated to give you your money back. Bank CDs have final maturity dates, 1, 2 years, so you know there is a date when that bank promises to give you your money back. We talked about yield, which is how much you earn, but there's one equally important consideration, and that's risk. Many bank CDs are guaranteed by an agency of the US government, but many are not. Your friend may be very trustworthy, but she's not the US government, nor are corporations. So how would you decide how trustworthy she is? What's her financial situation? How do other people who have lent her money think? Does she have a FICO score? Companies who borrow money have the equivalent of a FICO score called credit ratings. 3 agencies assign most of these with about 20 notches from best to worst, and the biggest distinction they make, that bright red line, is between what they call investment grade and non-investment grade. As with any opinion, reasonable people can disagree, and disagree they do. Between just S&P and Moody's, within the most actively traded 10% of the bond market, there's $130 billion that's rated investment grade by one and non-investment grade by the other. Pemex, for instance, is rated BBB by S&P, comfortably investment grade, while Moody's rates them B3. Deep into what used to be called junk last century, when bonds were just dusty tomes sitting in libraries and vaults. Credit ratings do have some value as broad indicators, and if a bond is rated within the top 7 notches by all the agencies, their opinion is that the credit risk is low. If a bond isn't in that club, but the agencies say it's in the next 3 notches, which is half of the corporate bond market, that's medium risk. Everyone else basically gets a FICO score below 600 from at least one agency. The important thing is that corporate bonds are a savings instrument, but they do have credit risk. Let's go back to your CD that just matured and say it was a $2,000 CD from Truist Bank. You check to see what Truist Bank is paying for a new 1-year CD and see that it's 4%. It turns out your friend actually doesn't need to borrow money, but she does tell you to have a look at corporate bonds since there are some that are pretty low risk. She says you can check your brokerage or this Goodfill app, set your credit risk to low and your maximum maturity to say 2 years. You do that, and lo and behold, there's a corporate bond from none other than Truist Financial Corporation, the owner of Truist Bank, that matures in 1 year and 3 months, yielding 6.03%. You check for any prepayment risk known as call risk and see that Truist Financial can repay you in 1 year and 2 months if they want to. Whether you're repaid in 1 year and 3 months or 1 year and 2 months, the worst your yield could possibly be is 6.03%, and that's to the final maturity, since the workout date is the same as the final maturity, and that's the case for 97% of bonds in the market today. For that 97%, you may be repaid earlier than the final maturity, but your yield in that situation will be higher, usually not by much, but it will be higher than the posted yield. We won't count on that though. We won't expect it. We'll just focus on the yield to worst. Now, you did set your maximum credit risk to low, so you have the blessing of the rating agencies. But while your Truist Bank CD that matured may have been guaranteed by a U.S. government agency, hard to tell without reading a lot of fine print, the Truist Financial Bond definitely is not. For that reason, it's best to check a few financial metrics. A couple of those you can see for any company in any industry are net income and tangible book value. Net income is how much the company is earning in a quarter or a year after paying all their expenses and charges. Tangible book value is the value of shareholders' equity after subtracting intangible assets and what's called goodwill. Basically, you're checking if they earn more than they spend and if they own more than they owe. Just to illustrate goodwill, let's say a company, AI Inc., has one investor who's invested $1 million. That investment's called shareholders' equity. That $1 million is also an asset of AI Inc. They can spend it if they like, but they actually put it in the bank, and the next day, Microsoft buys them for $1 billion. The difference between what Microsoft paid and net tangible assets in AI Inc., that would be a difference of $999 million is goodwill. Now, Truist Financial didn't buy AI Inc., but they had $59 billion in shareholders' equity at the end of last year and $4.4 billion in tangible book value. They also lost $5 billion in the fourth quarter and $1 billion in the whole year. What does all this mean? Truist Financial is supposed to be low risk. Now is a good time to look at one indicator called the probability of default. This is the bond market's view of the likelihood that this bond is going to default before it matures. It's calculated by looking at three things. 1, the maturity of this bond. 2, how much more is the yield of this bond, known as the spread, compared to a U.S. Treasury bond of the same maturity? And 3, the expected recovery rate of this bond in a default situation. The maturity and spread are very clear. The expected recovery is not clear until a borrower is very close to default, so conservative assumptions are set by payment rank. There are 3 bond payment ranks, and the highest is secured. Secured means the borrower has pledged specific collateral to back that bond in case they can't meet their obligations, just like you pledge your house to the bank when you take out a mortgage. Secured bondholders have assets available to just them and no other creditors. Next comes senior unsecured bondholders who have first dibs on everything not nailed down by secured creditors. Last in line are subordinated or junior bondholders who get what's left, and that's usually not much, if anything. All creditors are ranked ahead of stockholders who almost certainly get wiped out in any default situation. For the purposes of calculating a default probability, a recovery rate of 30% is used for secured bonds, 10% for senior unsecured, and 0 for subordinated and junior bonds. In the case of our Truist Financial issue, the spread to governments, or the G-spread, is 124 basis points. 1 basis point is 0.01%, so that's 1.24% above a U.S. Treasury with the same maturity. Based on that, the maturity, and our 10% recovery assumption, we see the market implied probability of default for this bond is 1.05%. Is that a high number? A low number? That depends entirely on how much risk you can tolerate, but looking at our $4 trillion of the most actively traded corporate bonds, half of them have default probabilities less than 8%, while 3/4 are below 20%. Remember, this is just the bond market's opinion and says nothing about a company's financial strength or business outlook. What we do know is the market is giving our Truist Financial bond 5 stars. We can say 2 things for sure about default probability, and one is that it has a definite time frame. The majority of defaulters are non-investment grade from the agencies, but many were rated that way for decades. Bed Bath & Beyond defaulted last year after spending 20 years in non-investment grade purgatory. At the other extreme, Silicon Valley Bank was non-investment grade for all of 2 days before it defaulted. The default probability says this is the likelihood that this borrower won't meet all their obligations to this date. The other thing that can be said about default probabilities for actively traded bonds is that they react quickly to news. Silicon Valley Bank's stock had dropped 60% in 3 days while its bond spread skyrocketed, and it was still investment grade from all the agencies. Not looking at default probability is like only looking at your friend's FICO score before deciding whether to lend her money without talking to anyone who is already lending to her. One mistake that people make, believing they're reducing their risk, is buying bond funds. The reality is the opposite. If you invest in any financial market, you're going to be taking at least one of two risks: credit and market. We know bonds have credit risk, and market risk means you may not be able to sell what you bought for as much as you paid. Stocks are all market risk forever. Actively traded bonds have a market price, but remember that bonds are savings instruments, so their market risk and their credit risk completely disappears at maturity as long as the borrower fulfills its obligations. The Vanguard VCSH is a $40 billion exchange-traded bond fund that's about half invested in low-risk bonds, as we divided the agency ratings earlier, and half in the medium zone. Remember, our Truist financial bond is solidly low risk, so $20 billion of this fund is in bonds with worse agency ratings. The problem is not the credit quality, it's the fact that you have to sell the fund in the market to get your money back. The fund's average maturity is 2.8 years, so let's say in January of 2021, you put in $2,000 planning to take your money out 2.8 years later in October of 2023, just in time for the holiday season. You would have paid $83 when you bought it, but 2.8 years later, the market price had dropped to $73.50, down 13%. You would have gotten a little bit of income along the way, less than 4% a year, but the principal of $2,000 that you invested is down to just $1,740. That definitely cuts into the holiday cheer. With any bond of any default probability, at least the issuer promises to pay you the full face amount, and even if it's less than you paid, as long as you focus on the yield to worst, you know exactly what you'll get at a minimum, provided the issuer meets its obligations. If you want your cash before maturity, you may need to accept less than you paid, and that's the market risk of a bond. As long as the issuer is solvent, though, that risk disappears at maturity. When you own a bond fund, you have market risk forever. You may see a basket of bonds maturing around the same date, sold as a fund with management fees, but is that the date you want? Are those the bonds you want? Is there enough yield? Is there too much risk? How much are the fees for that? When you pick your own bonds, there's only one rule to follow absolutely, which is only buy corporate bonds with more than $100 million in outstanding amount. Issues smaller than that can easily be ignored, which means they don't react to news, or there may not be as many buyers if you want to sell before maturity. In fact, for issues less than $500 million, stick to bonds that have traded more than 10 times per day on average for the last 2 months. We call these bonds the Goodfill universe, and they're the only ones you'll see on the Goodfill app. After that, you make the rules. What's your maximum maturity? How much risk can you tolerate? There's over $4 trillion and 4,000 bonds to choose from in the Goodfill universe. There's plenty for everyone, and you can diversify as much as you like. To summarize the key takeaways: 1. For a callable bond, always focus on the yield to worst to the workout date and know that you may not receive your principal until the final maturity. 2. Set your maximum maturity. 3. Check the probability of default and apply your maximum. This technique is widely used in the professional market and is available for retail investors only on the Goodfill app in the Apple App Store. Also, check whether the agencies collectively think the bond is a low, medium, or high credit risk. 4. Review the borrower's net income and tangible book value, and if they're not a bank, also check the leverage ratio and cash flow. Refer to our Understanding Credit Risk blog at goodfill.live for more about those. 5. Avoid bond funds. No amount of diversification is worth market risk that lasts forever. And lastly, avoid any bond not in the Goodfill universe. We haven't covered everything, but you've made a lot of progress, and if you buy stocks, many of your skills in reviewing company fundamentals will be very handy in picking bonds. Stick with it. Thanks very much for sticking with us, and here's to good fills.